Good day, everyone. We are here today with Sébastien Rhéaume, Principal Director and founding member of AlphaFixe Capital. Hi, Sébastien.
Hi, Terry.
So exactly 1 year ago, we launched the NBI Canadian Core Plus Bond Fund with the team at AlphaFixe. And I must say the strategy has been well suited for a very volatile environment. So Sébastien, maybe you could tell us, why did the strategy work and why it will be able to adapt to what may happen in the future.
So I think that when we're thinking about launching the strategy a year ago, we had a very strong conviction that the market environment, would be fundamentally different than what we've been used to for the last 10 to 15 years. So we were expecting a lot more volatility, but a volatility without a very strong conviction in terms of direction. So the last, pre-pandemic, 10 years before the pandemic, we had volatility, but in lower rates. So every year rates would be lower and lower, and we kind of hit the bottom during the pandemic. And then post-pandemic, we had a rising interest rate environment. So we had a lot of volatility, but with rising rates. And I'd say for the last year, we've had, again, a lot of volatility, but when you look at where rates are today versus where they were a year ago, we're a little bit higher than we were a year ago. So somebody could say, well, that's not much volatility, but if you look at what happened in between, when we started the fund versus today, we've had about 120 basis points of difference in the 10-year Canada rates, which is a lot of volatility. And what that does, that environment, it allows us as a manager to be able to position the portfolio to capitalize on that volatility. So what we have been doing the last year is when rates are actually going up, we will increase the duration of the fund and capitalize on the reduction of rates as rates come down. So we're able to add and improve the return of the fund by doing that. So that was one really strong strategy in the last 12 months. And the other very strong strategy was on the credit side. So we thought a year ago that it was quite compelling, both on the provincial as well as the corporate side. So we did overweight the portfolio on credit, and credit, on average, have probably compressed by anywhere between 35 to 40 basis points, a bit more in some of the more subordinated credit stuff. But in the end, having a lot of credit in the portfolio is also a strategy that's done quite well. So those are the reasons why it's done well, and why will it continue to do well? Again, volatile environment, ability for us to play that volatility and capture, that movements in spreads as well as on the credit side.
So, with the Bank of Canada having lowered its key interest rate last week, we also saw cuts in Europe, and there was expectation of eventual cuts in the United States. Can you tell us what you foresee for the market in the short and medium term?
Yeah, so we're at a tricky point right now. So again, the Bank of Canada started reducing its rates, probably justified given the fact that the Canadian economy seems to be a little more suffering for higher rates. So if you're only looking at Canada, you would say, okay, that's a good sign. Usually, when the Bank of Canada or the central bank starts reducing rates, that means we probably hit the top of the rate, so it makes sense to increase duration. Now, the tricky part is as long as we don't have the same signal from the Federal Reserve in the U.S., it's a bit trickier to say, okay, green light, let's go and add duration here. So again, it's a bit tricky. So we have to play both of those sides. So we want to increase duration, but not too much, because if the Federal Reserve actually starts raising rates later, or just says maybe we have to wait even longer before we start reducing rates. So that's something that we have to be cognizant about, because it's going to have an impact in terms of the Canadian rates also. We've seen in the last few days a lot of higher rates in Canada, all basically driven by what's happening in the US. So it's a delicate balance. And of course, as soon as we have more visibility that the Federal Reserve is actually going to start reducing rates, then that will be a more clear sign to increase duration in the portfolios.
So what I'm hearing is continued volatility, a lot of macroeconomic uncertainty. So, really a good environment for active management in fixed income.
Yeah, as like I said, so if you look at where rates are today versus a year, you could say not much happened, but in reality, rates have moved a lot in between, and I think that that's the volatility that we want to capture and that we will continue to capture going forward. So yes, an environment that should be very good for active management.